In this video, we will talk about investing for dummies and essentially provide a complete video on everything relevant as a foundation for when you are a dummy in investing. In other words, just a beginner in investing. And investing for dummies should be taken with a grain of salt. But I will explain everything about the basics, as well as types of investments you could make and how you can get started, along with other matters such as common mistakes. Why should you listen? My name is Jorik Vermeulen. I have been investing for over 10 years, almost 11 years. I started at the age of 22, 23. At 23, I became enthusiastic and started doing more. Halfway through, I also founded Happy Investors, a company where we stand for simple investing to help achieve financial freedom. Our products and analyses that we share on the website are all relatively inexpensive because I personally believe in minimizing your costs and maximizing your returns. However, if you are an investor just starting out, a dummy, there are a few very important things. I have become financially free around my 30s. I am now a bit older. I think I will be financially independent around my 35th, maybe 40th, depending on whether I have children or not. So that actually looks pretty good. I can assure you, investing is simply a means to achieve financial freedom. Just know yourself very well, because investing is more about mindset and psychology than substantive knowledge, especially if you simply choose safe and reliable diversification with a lot of risk and diversification, but you can also achieve higher returns. Of course, you are probably now in the first step of investing for dummies. You are just starting, you are also searching for this term. So we will go step by step, we will become more knowledgeable. But in this video, we will stick to basics. And first of all, we start with the why actually. Why would you want to invest, and what exactly is investing? Of course, the biggest why is actually what many people want to instill in you as a kind of fear about inflation, and saving money yields you nothing. And by now, that is actually the case because inflation is structurally high. So all your savings, yes, there is no saving against that. Simply put, your money is losing value. But the main reason to start investing is to make the money work for you, so that you can perhaps achieve financial freedom later, and as a result, you can, for example, work less. Maybe even stop working entirely if you want to retire earlier. Or you can simply use that money for other things. Whatever you want, the choice is yours. Investing is always just a means. For me, and also for happy investors, it represents investing to achieve returns in order to become financially free. And this is actually the main goal of investing, which is to achieve returns. When I just started, of course you have to learn a lot, and I still keep learning a lot. That's the fun of investing. You learn a lot from it. However, what I didn't quite understand at the beginning is that investing is not so much a game to achieve returns, rather investing is primarily a game to invest your money without losing it. That is a very different mindset, a very different approach. Therefore, if I could start over, I would not begin with my risky stocks. And later, in 2017, I started with cryptocurrencies, sold in 2021, but that's another story. However, if I were to start over, I would simply begin with a very safe, diversified foundation, continuously learn more and more, learn, and then also take on high risk. That is the goal of investing, to achieve returns at an acceptable risk, or preferably no risk at all. What does risk mean? Risk does not mean short-term volatility that fluctuates as long as it goes up. No. Risk means the chance of permanent loss of money. Whether you buy a stock that you don't understand and that stock goes down to minus 100% and you lose all your money, or you buy a small property at a much too high price in an area you have no knowledge about, and you also lose part of your money because of that. That is real risk. Now, important in what investing actually means and what its basis is, it essentially comes down to translating it back to intrinsic value. Everything you do with investing means you are going to buy something because you expect it to be worth more in the future. This means that when you buy it here, it has a certain intrinsic value. A property, for example, is worth 200,000 euros at market value. A stock, for example, is worth 20 million or 20 billion at a certain market value. What you want to know as an investor is how much that investment object is really worth. If you don't know that, no shame. Very few people know what intrinsic value is. So that's not investing for dummies, that's investing for advanced investors, but very few people really know what they are buying. So one of the common mistakes is that they buy things they simply do not understand. You are probably a step smarter and you do not buy what you do not understand. If you cannot calculate how much something is worth, then you simply should not invest in it because you do not know if it can be worth more in the future. You know that. Very good. Then the next principle, if you want to invest successfully, is to always maintain a margin of safety. This is a principle from Warren Buffett, one of the most well-known investors. It basically comes down to a safety margin. Suppose you are going to invest in a property that is worth 200,000 euros. According to the market value, it may be that because you have been searching for a long time, for example, you see an apartment for 160,000 euros that is actually worth 200,000 euros. Now you have a small margin of safety because you are buying for 160,000 while you know that if I buy it and want to sell it the next day, it is worth 200,000 euros. It works exactly the same with stocks. You buy a company that is actually worth much more than what the market thinks. With stocks, it is just much more complex, and I will also show you at the end of this video that it is indeed possible to achieve higher returns with stocks. Then we will be many steps further. So forget it. What you actually want to maintain in your life is simply a margin of safety margin. And you can't just do that with investing, but also with your financial situation. For example, don't buy a house that is too expensive where you will borrow the maximum. For example, don't buy unnecessarily many luxury items while you don't even have a savings fund, an emergency fund. So, for example, keep at least a certain number of months' worth of your income. First, you need to establish a solid foundation so that if something unexpected happens in the future, financial setbacks or worse, psychological setbacks, you can always fall back on the basics. So that is very important when talking about investing for dummies. First, create a strong, safe foundation and be patient with it. Take your time for that. Patience is also not my strongest suit, but I would swear to you, if I could start over, I would have made this video for myself and then listened to it. A crucial concept regarding why you should start investing and what it means is compound interest, or the effect of compound returns, interest on interest. And this actually leads me to a second step, which is, what exactly does investing for the long term mean? That is, you want to become financially free. And if you simply choose long-term investing, you have many factors in your favor. You have the advantage of time, you have the advantage that the economy can grow, you have the advantage that compound interest, or the phenomenon of interest on interest, works in your favor. The best investments always take a long time. Long is not 2 months, long means 5 or 10 years. Happy investors, we have had growth stocks that have simply gone up 5 times or even 10 times in 1 year, but that is exceptional. That is luck. With a good background basis, it is indeed luck. In practice, it takes a stock or a laundry pan several years to really double, triple, or quadruple. Moreover, if you want to learn advanced investing, go to our website where you can download free booklets about stocks, but also ETF investing and those kinds of things where they specialize in stocks. I will also increasingly move towards that, but for example, I have experience in crypto. I can advise against it. I consciously chose to stop with crypto to switch to investing in stocks and companies. Part of it is personal because it relates more to strength. I am an entrepreneur, I have certain feelings for it, and instinct. But part of it is also because with crypto, you simply cannot calculate what it is really worth. When you reflect on what investing means, investing is knowing what you are doing. Investing is not speculating. If you are going to speculate about a supply and demand that may occur in the future, and there will be many good reasons for that, fine. But that is speculating where you leave more of your turn and your chance of success to luck. I don't want luck. I want to have certainty that I am making a good investment. I want to know what the company is worth. I want to know what the intrinsic value is with a margin of safety so that I buy it cheaper than what the current price should actually be. Especially if the company is going to grow in the future, which could make my low price double, triple, or even tenfold. That is investing. Investing is knowing what you are doing, determining what the intrinsic value is, and then investing for the long term and having a lot of patience. That is actually the basis of what investing is and why you should invest. That is, of course, for financial freedom. Let's now take a look at a number of basic principles. After that, we will look at what types of investments there could be, especially when you talk about starting to invest. After that, we will make it increasingly concrete with how to start investing, avoiding mistakes, and some other matters. I will quickly show that even if you start at a young age, it is possible to build significant capital simply by investing. What you see here is not advice. These are risky stocks. It is really for the informed. I also regularly share updates on my YouTube channel with complete explanations about my investment portfolio. But you also see that some stocks are simply at minus 3,000 euros. And that is the reason why I use this video. So some stocks perform very poorly compared to others. Like in this case, one is doing very well at plus 17,000. But there are winners and there are losers. Sometimes a stock can drop by 100%, like Helios, and I have no idea. I bought it a long time ago. That is a very important point, because it is very important to know how a certain amount of money works. This is because understanding the mechanics of how a specific sum of money operates is crucial. In fact, it is essential to grasp this concept as it can influence various financial decisions. Moreover, the possibilities are endless when it comes to financial management, and anything is possible. You start very small at the beginning. Monthly contributions to investment funds, ETFs, bonds, whatever it may be. But in the long term, it grows into larger amounts and you become financially free. But everything only comes in the long term with a lot of patience and dedication.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
Let's talk about some basic principles. And to keep it simple, 5 basic principles that are relevant if you are a beginner investor, or in the context of investing for dummies. First of all, there is risk and return. It is very important that you know what your risk profile is. This actually means that you need to consider for yourself, what kind of person am I, and do I want to take a chance on a risk with potentially higher returns or not? Or rather choose a lower risk, more certainty, and potentially lower returns. So you can invest with a relatively lower risk and achieve a return of 5 to 6%. Fairly stable, without, for example, price fluctuations. That's all there is to it. If you are willing to gain more advanced knowledge in a certain area of expertise or domain that you have, you can achieve higher returns. And that can increase to, for example, an average return of 8% with, for instance, ETFs, with a good ETF investment portfolio, or higher returns above 10% with, for example, a portfolio consisting of stocks, perhaps real estate, maybe even flipping real estate, or even higher returns are possible with cryptocurrencies, provided you are successful. But you can also achieve very high returns with stocks if you know what you are doing. However, the average return is crucial. A second basic principle of investing is the time horizon. You actually have 2 different games in the market, and I will now talk about stocks, as that is my specialty after 11 years of investing, and I can speak more easily about it. In the stock market, you have short-term players and long-term players. In the short term, there is something called miss the market. This is essentially the invisible market with countless millions of investors buying and selling daily, and a lot happens. Sometimes I buy something in a day, your neighbor buys a stock, and countless numbers at a short-term daily level, the price fluctuating on a daily basis, but also on a weekly and monthly level. So, you have a lot of fluctuations of a specific stock. That company is currently worth 100 million, and you can buy those shares at a certain price, which reflects that the company is worth 100 million. You determine that the intrinsic value is not 100 million, but 150 million. You have done that because you have done a lot of research on companies, and you really understand it very well. And not only that, in your eyes, that company is not worth 150 million today, but in 5 years it might be worth 300 million. You can buy it today for 100 million. The company simply has good position in the market and is going to grow. You have found a gem. You have a relatively low risk because you almost know with great certainty that this company is worth more. You have determined intrinsic values and the margin of safety. You buy, yet you will see in the short term, on a daily level, but also on a weekly and monthly level, that the price will rise and fall. It will likely drop below that 100 million a few times. That is the market now. That is the game of short-term investors, while you are a long-term investor in this case. You know, you have bought, the only thing you need to do is hold on. However, noise is very difficult, especially on a daily level. So a very simple tip is actually to always choose long-term investing, as it increases your chances of success. And the second is, avoid investment apps. Don't download your app on your mobile, but just do it on a desktop and log in only once a month or once in a while. This way, you save a lot of noise. Time horizon is very important and determines what kind of player you are. You can also choose short-term. That's perfectly fine. You can even do day trading or swing trading, which is on a monthly or weekly level. It's entirely up to you. There are also opportunities in that, but the risk always increases as you shorten your time horizon. If you want to get rich in the short term, I wish you a lot of success, because the chance of losing a lot of money is very high. A few lucky bastards always succeed, that's just how it is. But very often, that is luck and has nothing to do with expertise or qualities. If you hear someone at a party talking, oh, I bought crypto, Shiba, something else, Dogecoin, it went up 10 times in 2 weeks, I can assure you 100% that is luck. Ignore that. Ignore everything about investing at parties. Unless you know someone who really has a lot of experience, just listen to that person about what they do. And if they have a bit of knowledge, they will say, pay attention to the risk. Choose elites for the long term. That is the time horizon. So we have now talked about risk-return profile and we have discussed the time horizon. The third basic principle is diversification. In other words, spreading risks. In principle, you should always spread risks, and that can be done in many different ways. This can be by buying, for example, 20 stocks. It can be by buying 30 cryptocurrencies, or it can be by purchasing multiple real estate properties. You always want to diversify. You never want to put all your money in one place, and that is a very important point. And that is also one of the reasons why I make these videos. So diversification is actually very important. And there is something else they call diversification, or you will end up with too many risks, but that is for another time. The fourth basic principle is liquidity. That is also related to your time horizon. If you are going to invest your money somewhere, the question is, do you really need it for the long term, yes or no? Because liquidity is actually about how quickly you can convert your money, your investment, back into cash. Savings have 100% liquidity because I can withdraw my savings from the bank at any time, provided that my bank doesn't experience a bank run. But savings are essentially very liquid, and cash even more so. Stocks are also very liquid, but for example, a rental property is not liquid. Or investments in P2P lending, a type of private loans, or in crowdfunding, those are not liquid investments. And sometimes it is useful to make liquid investments that you can convert into cash immediately when needed. These have actually become the strategies that you can apply later in your life, but not yet now. Then we have the fifth basic principle, which is about psychology. The most important basic principle is that when it comes to investing, it all boils down to psychology within yourself. First, you need to know yourself very well. Only then can you establish a good risk and return profile. If at some point you see a line of poor results, you won't be sensitive to it. Gambling. Then I wouldn't start with the training or crypto training because on a daily level it gives a lot of adrenaline kicks. Are you willing or are you actually stimulated to act quickly? While that often leads to poor results, right? Are you not sensitive to that? Then that's only good, and you might want to try it if that's your sport. Because then you probably have much more discipline to stick to fixed strategies within your day trading or within your crypto strategies. And those fixed strategies with a high degree of discipline are necessary if you are going to invest in the short term. If you are going to invest for the long term, then you only need patience. I'm just saying having patience is very difficult to muster, because we are talking here and now about the present day. While you are going to invest with a focus on returns for over 5 years, 5 years is a very long term. On the other hand, in 5 years you can achieve a lot. Don't let that discourage you. Another psychological effect, and there are many psychological pitfalls, but we won't talk about that either. If you are more interested in that, take a look at Charlie Munger, but also at others. When you start investing, having low expectations is important. The lower you set your expectations at the beginning in terms of returns, the lower risk you can take, and this way you can build a very good, stable foundation. And then you have a stronger foundation to achieve a return with more certainty. How do you do that? I will now tell you about the types of investments that exist. A quick overview, as we also have many in-depth analyses on our website and on our YouTube channel. But a quick overview from low to high, what the different types of investments are. Then we start with the lowest risk profile, which is the asset class, or the potential investment opportunities you have, which are bonds. Bonds provide a relatively secure return, as they are a type of obligation with a higher level of repayment, but often a lower yield. Like, yes, it can be up to 2%, but it can also be up to 3% or 4%. Bonds have the lowest risk, and the older you are in the future, or how old you are now, say you are close to retirement, you want to invest more in low-risk assets, such as bonds. Another interesting investment for beginners is a step higher, namely index funds or exchange-traded funds, abbreviated as ETFs. We won't go into detail about it, but it is very good for beginner investors to create an ETF portfolio, so multiple ETFs in which you invest, because then you can achieve a lot of risk diversification. An example is that with 2 ETFs, or even with 1 ETF, you can indirectly take a position in 10,000 stocks worldwide. Check out our video on the best ETFs for global diversification for beginners on our YouTube channel for more information. Finally, above that, a step higher is real estate. And in real estate, you have several options. Real estate funds are actually lower risk. And then you also have publicly traded real estate funds. Those are 2 different branches of the same field. And the last one is called Real Estate Investment Trust, abbreviated as REITs. And you can also find more interesting tips about that on our channel. Real estate funds pay relatively high dividends because they are required to distribute 90% of their income. as dividends. So a relatively higher dividend. On the other hand, there is still a bit more risk than, for example, exchange-traded funds or bonds. Because yes, fast food funds can of course also go bankrupt. Fast food funds are a very nice addition to ETFs, especially if you are a beginner investor. So it is super interesting to combine those two, especially since ETFs focus more on companies, and real estate is usually a different branch of sport. Next up is a step in terms of higher risk. Those are individual stocks. In between, there might still be crowdfunding and P2P, lending, so private investments. But that's not all that interesting. Stocks are very interesting because with stocks you can, in principle, achieve very high returns, an average return of over 10% or even higher. Although the best investors can achieve around 20% or even 30% returns over a period of 20 to 30 years. But those are the very best investors. As a beginner, you shouldn't think about that, but maybe over time, we'll get better and better at it. For example, you can achieve a return of over 10% or maybe even 15%, who knows. And what is interesting about stocks is that you can make selective investments in companies that you fully understand. You still need to apply risk diversification, but you know those companies so well that you can build in a margin of safety because you know they are worth more than what the market is willing to pay for them in the short term. So you have a lower risk, and precisely because of that, you can also potentially achieve higher returns. So it is indeed possible to achieve a higher return with low risk. But it takes a lot of time and energy, and it is no longer investing for dummies. This is investing for advanced investors. Also, more advanced investing includes commodities. Think of investing in, for example, gold, but certainly in volatile commodities such as oil and energy. It can be a valuable addition to your overall investment portfolio. Finally, you have an even higher risk. This includes investing in cryptocurrencies. I find it speculative, but it is of course very interesting. Personally, I would only stick to Bitcoin and Ethereum, but who am I? And on top of that, for example, private equity or venture capitalists. But that is again for advanced investors. A very brief summary of different types of investments when talking about the framework of investing for dummies is to assemble an investment portfolio. That means making multiple investments. In this case, diversified investments. So you might be talking about bond funds, supplemented with exchange-traded funds of stocks and real estate funds. Personally, I am really just a long-term investor. I do this for at least 20 years. For me, it is not rational to invest in bonds. It simply yields too low a return in the very long term. It has been proven that stocks achieve higher returns than bonds in the long term. So I stick to stocks and real estate funds. I personally invest in stocks. However, if I could start over as a newbie when I was 23, I would first start with exchange-traded funds, as that prevents many beginner mistakes. You also learn from that, but it is an expensive school of learning. Now let's talk about some concrete tips on how to start investing and how that relates to assembling your investment portfolio.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
Then the question is, okay, Jorik, give me some tips on how I can start concretely. And unfortunately, I have to keep it a bit abstract for now because first you need to do some preparatory work. I already mentioned, investing is more about mindset than actually knowing what you're doing as a beginner. Because as a beginner, you definitely need to apply a lot of risk diversification, and then you can start taking more risks from that strong foundation because you know what you're doing and potentially achieve higher returns. A few things you need to know before you start are your financial goals. Always invest only with money that you can afford to lose. This means, first of all, always maintain an emergency fund and have enough for several months to handle financial setbacks. Know what your financial goal is. Then you need to determine your risk profile and based on that, assemble an investment portfolio. How do you do that? Well, go to our website happyinvestors.nl or internationalbusinessinvestors.nl because we make these videos in our Dutch language and translate them via an AI program into English internationally, but that's another story. Go to our website, there you will find a free tool called Calculator, and you will also find a free investment portfolio with examples about how you can assemble an investment portfolio, or take a look at our YouTube channel, where you will also find many video examples on assembling an investment portfolio. So you need to know what your financial goal is and of course map out your finances, and it really comes down to how much you can invest monthly, and based on what, it will determine which investment portfolio to invest in based on your return and risk profile. Finally, you need to have brokers. If you want to invest in ETFs or stocks, you need an investment platform. We will not discuss different investment platforms here. That purely depends on which country you live in and also what your preferences are regarding investments. But there are plenty of examples to be found on the internet, and we have also made reviews about that. Finally, the fourth and last point about how you can concretely start is that you need to determine your strategy well, and it really comes down to knowing how much you can invest and knowing in which investment portfolio you will do it. So you have created a diversification in different asset classes, ETFs, real estate funds, stocks, you name it, and then you just need to start investing concretely. But the question is how? Suppose you have a lot of money, let's say 50,000 euros, 500,000 euros. You start all at once. That's called lump sum, investing everything at once. Will you choose a monthly or periodic contribution? The truth is that it greatly depends on your strategy and where you are going to invest. If you invest with very low risk and a high degree of certainty, then you actually want to invest as much money as possible right away, because that compound interest effect can work in your favor. However, if you are going to invest in stocks or ETFs that are publicly traded, then it is a more specific case. From time to time, the stock market is heavily overvalued, approaching a potential bubble, and I would personally choose a monthly contribution so you can gain a bit of experience. When we talk about investing in general for dummies, beginner investors, I would personally choose a small monthly amount, investing a small fixed amount every month in various low-risk investments. That is one of the reasons why I mean this company. For example, price fluctuations in real estate are a different story. If you have waited a long time and see a good property that you can buy below its intrinsic value, then you should just go for it because you know what you're doing. You have had a lot of patience. You have done a lot of research. You know that the company values the property more than what you paid for it. So yes, then there is no reason to hesitate, of course. So that is strategy. You need to have a financial plan. What are you going to do in the short and long term? Risk profile and investment portfolio, a number of investment platforms to be able to start investing in those needed, and your strategy. 4 tips. I can't make it more concrete than that. Otherwise, I tend to lean towards personal advice. But if you have questions, share them and I will respond. Thank you for your patience. Finally, the last part. A few tips on common mistakes and also what the success factors are if you are a complete beginner. But don't worry, the common mistakes that I am about to mention, I have all made myself, even multiple times. So yes, it is what it is. And yet I have achieved positive returns all this time. Only it will, no matter how you look at it, come with mistakes. And there will be periods when you are simply in the red. It can't be helped. Only if you buy after a market crash do you have a perfect entry moment, but that only happens once in a while. First of all, one of the biggest, most common, but also most expensive mistakes is having greed, especially when you are, and that is me, young. And you think, wow, bam, I'm going to crush it. I'm going to become financially free, financially independent, this and that. Will probably take too much risk. That is why at Happy Investors, we guide a lot of people, now more than thousands. Community also has more than thousands of active members. And I prefer to work with women because they simply have much more emotional discipline. For me, it's greed. And because greed leads to taking too much risk. That is one of the biggest mistakes that many beginner investors make. Don't think you are smarter than the market. That is often punished. Just start calmly with a strong foundation, low risk, and let money work for you while you can still sleep well. The second common mistake is that you trade based on your emotions. And this is often linked to investing in what you do not know. That is a third common mistake. Actually, I want to combine those two. Why? You often see this at parties. Wow, bam, I bought a Dogecoin. The cryptocurrency is skyrocketing. Or wow, look, this Tesla stock is going through the roof. However, you don't know what you're doing because everything you hear at parties or at well-known cocktail parties is about hype. You also only encounter hype in the news. I invest Giro, and then you receive a newsletter. That newsletter is worthless because you only get the top 5 popular stocks that have been heavily bought or sold. But that is exactly not where you want to be in that area. That is hype. It is based on emotions, and you should never trade based on emotions. You should invest in what you understand, of which you know the intrinsic value, and for which you have a margin of safety, meaning you buy it below the price. And you can only determine and establish that if you know what you are doing. So avoid everything that has to do with hype, and don't let emotion speak for you. Another common mistake is applying too little diversification. And that may also come down to overestimating yourself and not knowing what you are doing. And worse, being greedy as well. Yes, if you have that combination, you will make many mistakes in the beginning. And I can honestly tell you, I also have a lot of self-confidence. Maybe in the eyes of others, that will be overestimating myself. But fortunately, I have learned after more than 10 years of investing, oh yes, wait. It is harder than you think. It is possible. You can achieve high returns on average, but it is harder than you think. So just stay calm and always start with enough diversification. Then at least you start as a dummy investor, but you will have positive returns. Finally, invest with what you can afford to lose. That is actually the biggest mistake you can make from a financial perspective. You should always invest money that you can afford to lose in the long term. Especially if you are playing the long term of over 5 or 10 years, you need an emergency fund and invest for the long term. Only money that you can afford to lose, because you shouldn't take it out when the markets are falling, Mike. It is precisely when the markets crash that you want to buy more. When the real estate market implodes, you want to buy more. Those are not the moments when you want to sell. You must sell. Tip for advanced investors. The best, most golden opportunities and highest returns with very low risk are achieved when people are forced to sell in a downward market. That is really when the golden opportunities arise. Unfortunately, that doesn't happen very often, but examples include the financial crisis or the dot-com crisis if you go back a while, even further. A number of crises, and suddenly during such a time, there is a huge crash. Then you just want to have money to invest and go for it. Then you are no longer a dummy, but you achieve very high returns. It's all possible. But you need a lot of emotional discipline and to know what you are doing. Well, if you turn those things around, in other words, what Jordi Mungal always says, invert, always invert. So think back to what you want to achieve and then do not do the things that prevent you from achieving that. What are the success factors then? You are a dummy. You are just starting to invest. What are the success factors? Well, if I may summarize, there are several, but to keep it concrete, just 3. First, always opt for the game of long-term investing. It's quite interesting that you have somewhat lower returns and that you can't join the conversation at parties. Your goal is long-term investing to achieve returns. And by choosing the long-term game, yes, you gain so many advantages that your risk automatically decreases, simply because you have patience. You must combine this with enough risk diversification, of course. And then you need to have a lot of patience. So long-term investing with a lot of diversification goes hand in hand with having a lot of patience. This also means that you shouldn't log into your investment account every day. That is pointless. That only creates counterproductive effects and noise. So choose long-term and very patient. If you do those 2 things, then you are essentially already successful because you will achieve returns anyway, provided you have the right diversification in your investment portfolio, of course. Then finally, a third is the road. It is so easy to start with high risk. Anyone can do that. But what not everyone can do is have the discipline to start with low risk, with a strong, solid foundation. I am also curious, you have watched this video, maybe you watched it all the way through, then I have respect for you. Returns achieved, there are very few people who can tell you that. I am also curious, you have watched this video. Oh wow, maybe you watched it all the way through. Then I have respect for you. If you have watched this video, and you have chosen a stable foundation, and in 6 months you have a positive return, then I would like to know that from you. A small tip of the veil, if you are going to choose stocks, be a little careful, because the stock markets are at a very high level. So be careful with that. Know what you are getting into. And when you start, do it with a lot of risk diversification. Thank you for watching. Let me know what your questions are, and see you next time.